Good morning. Welcome back to Your Money Matters. I am Angela Giroux, publisher of the Bauman Letter. And joining me today are Clint Lee, research analyst, and Ted Bauman, editor of the Bauman Letter. Now, we want to jump right into it because we're excited about what we've got today, a bunch of opportunities. But before we do that, just a quick reminder, of course, if you want to check out the Bauman Letter, there is a link below. But today I did want to make you aware that that is just the tip of the iceberg of everything that Ted offers. He has a high-end research service called Alpha Stock Alert. It targets fast-moving plays, bigger gains, and it's certainly delivering. I know we just closed out a 150% winner, and we're beating the market in our open positions by about 3 times. There's a link below for more information there. But now let's turn to the markets, because as we've been saying, there is this sort of market rotation going on. We called it early, and now we're really seeing signs of that, and we're seeing those headlines everywhere. So Ted, which sectors should we be targeting at this point?
Well, I think there are a number of different ways you could approach it. But before we do, I just want to mention, I think, the rotation has 2 sources, and it's important to understand both of them. One is the perception that regardless of what's happening with the pandemic, that the economy is recovering in terms of retail sales, in terms of foot traffic, all those short-term measures. So people are getting more positive, which is, it's hard to tell whether that's justified or not. But the other one, I think, is simply that the rate of potential increase in the stocks that have done well this year is topping out. There's a limit to how much money you're going to be able to make by continuing to invest in the high flyers. And to illustrate that, I want to show a chart that shows Amazon since the beginning of the year. Amazon has had a great run. As you can see, it's really been up very significantly since the March dip. But lately, it has begun to consolidate. It's really been bouncing off a line of resistance and seems like it wants to stay where it is for a while. And I think that's a proxy really for the kind of stocks that were doing well in the first half of the year. I want to show the second chart that shows a number of sectoral ETFs. Basically, they involve things like transports and industrials, consumer durables, financials, and energy, things like that. And as you can see, Amazon is the blue mountain at the bottom. All of those sectors are outperforming Amazon over the last month. And for me, that's an illustration precisely of what we're talking about, that investors are starting to look at, we could call them beaten down sectors, but essentially sectors that, regardless of whether we have a pandemic or not, they still need to exist. The companies are still doing business. They're still transporting goods. They're still doing financial deals, whatever it is they do. Industrials are picking up. And the likely rate of change of those stocks going forward is going to be higher. And therefore, the smart investor goes for that because they're going to make more money than if they stick with the ones they already have. So people take profits like they did with gold, like they did with bonds. They shift that money into these kind of stocks, and hopefully we'll see some momentum behind them as people recognize that they are the next big play. So I would look at those everyday sectors, go to the websites that have the ETFs, either buy the ETF or look and see what their holdings are, and invest in some of those.
Great. Clint, what do you see?
Yeah, I mean, in addition to sectors, I would throw out country-specific opportunities as well. And that's something Ted and I talked about last week in terms of the rotation that we could start to see into international markets, and we specifically highlighted emerging markets as part of that. But there's also an opportunity with Japan right here. So EWJ is a Japan ETF. And I know when people hear about Japan from an investment perspective, the news for a while hasn't been all that great. I mean, the stagnating economy, demographic challenges, that's led to deflation. But this isn't so much a play on a recovery in the Japanese economy as it is getting exposure and leverage to some pretty big catalysts out there, including factory automation, robotics, the 5G infrastructure build out. Because look, just like the S&P 500, those are companies domiciled in the US, but they don't get all their revenues from within US borders. They get actually about half their revenue from outside the US. It's the same thing here. These companies in this Japanese ETF are global in nature. They have exposure to these key catalysts, but then there's something else as well. one of the first charts I want to show you here is the valuations relative to the U.S. and the rest of the world. So looking at this chart, this is the forward PE ratio. You can see the U.S. Comes in at about 23.1 times on their forward PE. When you look at the rest of the world, so all stocks across the world, 20.6, but then Japan coming in at 16.7. Now, a lot's been made about the valuation of the U.S. market, how we're running basically somewhere in the 90th percentile, meaning only 10% of the time in the entire history of the stock market has it been more expensive. This is an opportunity to start to look at that valuation plays. One other thing I mentioned about the Japan ETF as well is that industrials is the #1 sector. Industrials makes up about 20%. Ted, that's something you mentioned just a moment ago. Mm-hmm. Now, the last thing I want to show you as it pertains to this ETF, so we talked about the fundamental aspect of it, but there's a favorable technical setup here as well. So this is a chart of EWJ going back about 20 years or so. And so once again, this is going back 20 years. And if I were to extend this chart back even further, you would see price topping out at sort of that 60 to 65 level 2 more times. So that's how important, how critically important that 60 to 65 level is. And we're right there once again. We're approaching that level, as shown with the arrow here on the right-hand side of the chart. And that's why if with the valuation, with the growth catalyst, if we start to see a breakout above that 60 level and then 65, because of how important that's been in the past, you could see some really big gains out of this ETF.
And now, Ted, I know one asset class in particular, one of your favorites, and we've been doing very well with it in the Bauman Letter portfolio. I know you wanted to highlight that as well.
Well, yes. I mean, I think as Clint is saying with Japan, there are these sleeper sectors, sectors that people tend to take for granted. They just, think, oh, that's old school. That's yesterday's, investment strategy. But there is history behind my rationale, and that is real estate. And I don't mean buying houses. I mean talking about real estate investment trusts, which are the primary vehicle for investing in real estate of different kinds. Real estate investment trusts are simply companies that invest in different types of real estate, whether it's retail, whether it's data centers or cell towers, anything that needs a physical footprint on the ground, these companies buy it. Now, the great thing about REITs is, number one, that they're backed by solid physical assets and one that tends to appreciate over time, which is real estate. Take the buildings off, it's still land, it's still worth something. But the other thing is that real estates perform extraordinarily well in the aftermath of recessions. I want to show a chart that shows the performance of VNQ, which is the main real estate ETF, vis-a-vis the S&P 500 from February 2009 up to kind of early 2013, which was its peak. I mean, it beat the market by 80%. And the reason for that was because it was starting from a low baseline, because people had a knee-jerk reaction. They'd sold a lot of their real estate investment trust investments. They thought, these things are finished. The economy's in a chaos, so let's get out of them. And then, of course, the world didn't end, and people still needed physical real estate. They still needed buildings on real estate, hospitals. They needed apartments. They needed senior living homes. They needed all the things that REITs own. And these things then took off like a rocket. Now, the great thing about REITs is that they have to pay dividends by law. Because of their legal structure, they have to pay 90% of their taxable income as dividends. And if you invest in them now at a low point, you can lock in a higher yield on cost going forward, which means that particularly if you're the kind of person who reinvests dividends back into the company, you could see massive compound growth going forward. The chart I showed you doesn't include dividends. It's just the share price. You include dividends, that goes up substantially. So those are 3 asset classes that I think have really good prospects in front of them. Again, we're not predicting exactly when the turn will happen. That's a fool's errand, I think, as we've all learned. The critical thing is that they have all the fundamentals, all the logic behind them, and we feel comfortable saying we think things are going to turn in that direction.
If I could just touch on REITs a little bit more, because it is such a sort of broad topic. You've got mortgage REITs, you've got equity REITs, and then even within that, there's different types. Are there any more specific type REITs that you think could really show some serious gains following the recession?
Well, for one thing, I think there are certain REITs that haven't gone down substantially. That would be the technologically oriented REITs like cell towers and data centers. They've held their value because they are the backbone of the Amazons of the world. Amazon wouldn't exist without data center REITs. So they haven't lost any of their value. For me, the ones that are critical are the ones that people think are going to be trashed by the pandemic, but actually aren't being. That includes things like shopping center REITs, apartment REITs, senior living REITs, those kind of things that people think, oh, we can't go there now because it's retail, etc. Even mall REITs, I think, have some potentials because there are, talks of using empty big store spaces for Amazon distribution centers. That may not please everybody, but it's likely to keep those REITs flying. And then, of course, you have what they call the net lease REITs that lease small individual buildings to places like Dollar General and fast food shops. Again, those things are not, they're not disappearing, and those are absolutely good investment plays. The only ones I'd be cautious of at this point would be the mortgage REITs and the big mall REITs that are not showing a transition, the ability to transition, the ones that have poor balance sheets. Those ones you might want to steer clear of, but there's lots of opportunity there.
Great. I think that about covers it. 3 great ideas to see us through this market rotation. Again, for more information on Alpha Stock Alert, which has more specific recommendations and bigger gains, please click the link below, and we will see you next time. Thank you so much.
Thank you.